On a firm level, one of our core values is generosity, and not just in monetary gifts, but also in the time and care that we put into our clients. And we hope that you feel that as clients when you walk in the door, that we really are here to serve you, and also our community. I'm born and raised in Cache Valley. This is home for me, and we had the privilege as a team to go and tour the Cache food pantry. That was the first time I'd walked through the food pantry, and I've lived here my whole life, and it was mind-blowing. If you haven't been over there, go tour the facility. It's awesome to see what they're doing. It's been a great organization that we've been proud to be part of, and really cool to see what they've done, and they've been expanding and made some great efforts. So excited to be part of this, as well as Cache Education Foundation is another organization. We have a couple of our team members, David and Lori, who sit on the board for Cache Education Foundation. This is a nonprofit that is designed to support local schools and students. And so it's been tremendous to see the growth and the impact that this organization has. This is a picture over here of Debbie and Lori. If you know Debbie and Lori, you know they're the perfect people to be decorating these trees. We donate these trees to the Jubilee. It's actually next week to be auctioned off for the foundation. And Debbie and Lori have spent a good amount of time getting things all ready, and they're the perfect people to be doing that. All right, so turning the page now to our investment team. So Cormac Murphy and David Kastner have joined our team over the last few years. They were managing billions of dollars, thousands of people over at Charles Schwab, and decided to choose Cache Valley as their new home, and really brought, like I said earlier, a new level of sophistication in what we're able to do on the investment end. So a huge part of this is the CFA designation, Chartered Financial Analyst. I would go as far to say this is the hardest designation to obtain in the industry, or one of the hardest. It's years of work, and most firms are lucky if they have one on their team. We have 5 CFAs that are part of Adams Wealth, and so we're stoked about this. Over the last few years, as we've evolved and grown, we've been able to be recognized by a couple of large-scale, not just on a state or local level, but on a national and global level. Barclays Hedge Barclays is a global company that recognized us with some of our performance on a couple of our funds. And so a few of these recognitions that we're just stoked to be, and even as I'm from here, this is home. It's crazy to think that little Cache Valley is on the map when it comes to these larger scale investment pursuits. So super excited to hear from David and Cormac today. David will be kicking us off. David's the managing director of our wealth management offering, and so I'll turn the time over to David when he's ready to jump in. Thank you for coming.
Good morning. How are you? I see some familiar faces here. It's good to see you all. What a difference a year makes. Last year about this time, we did a market outlook event. The market was down about 30% from the beginning of the year. Look at it now. We're back up really close to new highs in the S&P 500. Technology stocks have made new highs. It's just a different game. Same time, we've got some of the same worries that we're looking at in the markets, in the economy, and we're gonna cover that today. We're gonna look at really where we are, where we came from, and where we think we're headed. And Cormac's gonna come in and do some of the outlook on interest rates, where we think the economy's going, where we think the market's going, and geopolitics, politics here in the U.S. So that should be really exciting. So I want to start with where we came from, and I'm going to buzz through this because I think a lot of you are familiar already with where we came from and what started this whole roller coaster that we've been on. And inflation, we can point to inflation was the problem. The Fed stepped in. This is the S&P 500 index. We started last January, 2 Januaries ago. It's almost been 2 years. Amazing. The Fed started raising rates. Inflation was raging. Economic indicators started falling. We saw concerns about recession spike. 85% of economists out there thought we'd have a recession by the end of 2022 or early 2023. We haven't seen a recession yet, right? The market started to see that. Indicators came out and blew people's socks off, blew the market socks off. And we started to rally after being down about 30% at one point. Through the end of the year, we were down 20% still. And as I said earlier, we're back up near record highs. And that's because inflation peaked, the Fed has stopped raising rates. It's all a good story right now. Are we out of the woods? Absolutely not. So let's step through a few things. One of the issues was that the Fed was slow. They had this narrative that when inflation spiked, it was due to transitory factors, the stimulus from COVID, the trillions of dollars put out into the economy. They thought it would stop. They thought we'd get a nice little spike here and come right back down. We just don't have, what they said, we just don't have those fundamental underpinnings of inflation to get that kind of spiral that we saw in the late 70s, early 80s. So they sat on the sidelines until March of 2022, and they realized, holy cow, we're wrong. We're wrong. And the market already started seeing that. As I said, the market topped at the beginning of 2022 and started coming down. It was already down quite a bit by March when the Fed said, we're going to tackle inflation. We're going to raise rates so quickly, so fast, we're likely going to slow the economy. That's the only way to tackle inflation is decrease demand. By decreasing demand, supply would eventually come on to meet that high demand. In fact, usually there's an oversupply of goods and services that then results in that recession. And they didn't rule it out. They said, in fact, at one time, for the first time I've ever seen in my career, 35 years now, is the Fed actually predicted a recession themselves. They said, we're going to tighten enough to slow demand, we're likely going to see a recession. They raised rates, the markets didn't like it, of course. Indicators, we're showing economic indicators. This is the leading economic index. We're showing a recession is on the way. When it dropped below that red line there, that's the warning. Right? And this is a track record going back to the 1960s, earlier actually, 1950s, has never missed a recession. When it drops below this area, we've had a recession. False alarm. The market is one of the best indicators of the economic prospects. It's the best leading economic indicator. It got it wrong. What happened? Fiscal policy. The same stimulus that caused all the inflation is also supporting the economy. And the thing about fiscal stimulus is it's not just the trillions of dollars that built up savings among consumers during the crisis, but the momentum effect, the spiral positive feedback cycle that takes place when the stimulus is added. Well, Congress didn't stop there. 3 more waves of stimulus after it was clear the economy was back on its feet. Even as the economy was opening up, people were able to get out the streets again, spend down their savings that they built out. We got an infrastructure and transportation package, a clean energy package, and then the manufacturing package to support onshoring of semiconductors and so forth for geopolitical reasons. We still have a lot of that fiscal policy, that fiscal tailwind that's pushing our economy. That's why the market was wrong. That's why the Fed, in a sense, the Fed has been right. Granted, they changed their story. They came out and said, no, we think that we can now avoid a recession altogether. We think we can engineer a soft landing. The market still didn't buy it until the economic indicators started saying otherwise. The economic indicators showed some surprise. This index here is called the Citigroup Economic Surprise Index. And what it measures is what happens, what are the actual data relative to what economists expect. So before every economic report comes out, whether it's retail sales, the jobs report, whatever, economists go in and say, this is what it's going to be. The unemployment rate's going to be X, 3.6%. Well, it comes down to 3.4%. This index starts climbing here. This is a blow-up image of what happened. When this line is climbing, it means we're beating expectations. The market moves on expectations. not always the facts, not always the data point that might see. We can have times when the economy is still in a bad situation, but the reports come out and beat expectations, the market goes up on that because it's always relative. That incremental change is what drives the market. So we started seeing strength in the economy. The indicators came out, they're showing strength. With the fiscal spending that took place, that tailwind that took place, that supported job growth. In fact, businesses couldn't hire enough people. Remember that the shortages that we were seeing. Some businesses couldn't open their doors because they didn't have enough people. They had to start raising wages. The unemployment rate drove down to 3.4%. That was the lowest since the 1960s. You can't get much stronger than that. There's always going to be this transitionary type of unemployment. We haven't seen anything like that for so many years. That strength in the economy is reflected in the jobless rate, in the unemployment rate, job growth. And the reason for that is when people have jobs, they spend money. They've got money to spend. And that's the lifeblood of the economy. In fact, 2/3 of our economy is based on consumption, individual consumption. You have jobs, you spend money. Our nation's very good at that. When they've got money, they spend it. They don't tend to save it. In fact, those savings rates have been pulled lower because they just keep spending. Even as they start to run out of that era of high savings rate. This is personal consumption. So this is an economy-wide dollar volume of consumption in our economy. This is the crisis. It obviously stepped down. We've since seen it go up. It has started to level off. We can't continue that pace forever. We can't continue rallies like we've seen since last year. I guess we're at about 25%. No, even more than that. I think 35% off the lows altogether. The market's doing fine, but it can't continue at that pace. Consumption couldn't continue at that pace. But it is still positive. That's because of those underpinnings, the tailwinds of the economy. We are seeing some softening. Like I said, there are question marks out there how long this will continue. Interest rates are still high. The Fed is not giving any indications they're going to stop or they're going to cut rates anytime soon. The market thinks we are. I'm going to let Cormac Murphy come up in a little bit and talk more about interest rates. But we are seeing some softening around the edges. The red line there is job openings. It went to record levels. Like I said, businesses couldn't find enough employees. Job listings out there are at record levels. That drove wages higher. They had to pay people more to work. That has since softened, rolled over, and you can see that with the blue line, which is wage inflation. That's rolled over as well. There's good and bad with that, right? The good part is we don't have this spiral that's causing businesses to have to raise prices. At the same time, it's still positive. Consumers still have jobs. Wages are going up slightly more than inflation. People have money to spend. Always watching indicators. We watch this type of situation where wage gains, job openings are a very good indication of what's going on in the economy. We are seeing some slowing. We're not out of the woods. The markets and economists were wrong last year. Are they going to be wrong going forward when they expect rate cuts? We don't know. Right now, there are rising expectations again that we could see a recession next year. The markets tend to price those things in. Right now, the market's saying no, we're doing okay. So can't say never on these things, but let's look at inflation and see what happens because we did see that peak. Get this to turn. There we go. This blue line is the CPI. At one point, it was up 9% year over year. We hadn't seen that since the early 80s when inflation was on its way down after the Fed got really aggressive. After the Fed, Paul Volcker put us into 2 recessions, deep recessions on purpose. We thought we had some of that same narrative going with the Fed when they actually predicted they were going to put us into recession. That didn't happen, right? Now inflation is diving. This 2% line is right here, this green line is the Fed's target. they see stability when inflation is around that 2%. It will bounce around, but businesses can operate on that. Consumers can operate on that. As long as they have an expectation of somewhat stable prices, of somewhat stable interest rates, people can operate, businesses can operate. They can order ahead when they know, hey, if do I need to order now in the expectation it's going to be much more expensive later? The risk is they order too much, demand goes down, and they're stuck with inventories. That's when recessions happen. When things are more stable, they can plan ahead and do that effectively. Now that inflation has come down, the Fed has paused. This red line is the Fed funds rate. You can see how much they had to raise interest rates to start to achieve their objective. One of the reasons, as I mentioned, was fiscal policy. They had to fight that. So we still have an offset, a positive offset against the negative impact of higher interest rates. What we're seeing is maybe the Fed was right. Maybe it was transitory in nature. It just took longer and went higher than they initially expected. And we're seeing that inflation's really, if you look under the hood, we're doing quite well, even if it's higher than the Fed wants right now. One of the reasons for that is housing. Rent is one-third of the CPI, the way that's calculated. This blue line here is rent inflation as calculated as part of the CPI. This is going to come down, and the reason we know it's going to come down because this is the actual rents out there. When you look at listings, get online and look at rents, the inflation rate of rents have come down. This is a Zillow indicator of that, where this is actually what people pay because leases are generally a year long. There's generally a year lag in that rate of inflation. So we're seeing that come down. That's a good thing. We're seeing interest rates after having spiked earlier this year continue to spike. Even after the Fed stopped raising interest rates, the markets responded negatively to that. The volatility in interest rates, just like inflation, are hard for businesses to deal with. It's hard for individuals to deal with. Obviously, housing, that's it. They've had a big slowdown in that. So interest rates are really the lifeblood of our financial system. Without having some certainty in that, we're going to have volatility in our economy. We're going to have volatility in the markets because of it. So I'm going to turn it over to Cormac here. He's the fixed income expert. He and I have worked together for, 10 years. Charles Schwab managed money together, and he's the guy on interest rates. So I'm going to turn it over to him to talk about that, and I'm going to dodge the whole topic of politics. Yes?
Can I ask you to go back about 3 slides?
Sure.
One more. That one.
Yeah.
Is that consumer debt that is increasing with the spending?
Consumer debt is increasing with the spending. That's a great question, great comment. Because even though there were a lot of savings, they're spending that savings down, the lower spectrum of income earners are taking on a lot of debt. And they're taking on a lot of debt that's typically variable, credit card debt. With interest rates up, the prime rate for interest rates right now for the best borrowers is 8.5%. Add another 2% on that for people that aren't prime borrowers. Now we're talking about some real headwinds from that segment. So there are some concerns. We're watching that. Auto loans is one big concern because those continue to stack up. They're still buying cars. Even though some of their other consumption of goods have tailed off, they're still spending a lot on services where the economy transferred, they're purchasing after the economy opened. Something to remember here, though, is the other 2/3 of consumers are in quite good shape right now. Not only have investment values gone up, their house values are up. They've got plenty of access and capacity to take on debt, but they're not doing it. Household debt is very low. You think about interest rates. People who have savings and fixed income, they're now earning more, so there's a lot of interest income behind that. You think about rents. Rents went up through the roof. Those that own rental apartments and so forth, houses, condos, they're earning more. The baby boomers, they accumulated a lot of wealth through time. They're now retiring and spending down their money. They're passing along their wealth. Their kids and grandkids are more than happy to spend that money, and they're doing it. So even though debt is an issue, we're watching that. Federal debt's an issue, and Cormac touched on some of that too. It's not to that point where we're flashing the red sign yet saying warning. Does that make sense? Good. All right, we'll have some more Q&A at the end as well. But if you have questions along the way, please speak up and think about some questions you can ask Cormac.
Great. Is this working? All right, good. Well, yeah, as David said, I'm going to talk about interest rates here. And really, at the end of the day, it's becoming a bit of an old story, but it's still the story. Inflation and interest rates are going to be the focal point of the markets for the foreseeable future. Minimally through the first half of next year, but the story just, it's what everybody's focused on, and as David said, it's the lifeblood of the economy, so rightfully so. With that, the most important thing with interest rates, as David alluded to as well, is volatility. Where we're at in overall levels is not high from a historical standpoint. We're at a reasonably high point, but not anything totally out of bounds. Businesses can function on this. Credit markets don't seize up. So we're not at this, despite it feeling a lot higher, it's actually historically kind of a normal area. What is important though is markets' confidence in the Fed. And when we go back, what we're looking at here are inflation expectations measured by, there's these securities called Treasury Inflation Protected Securities. They're Treasury bonds that adjust with inflation. So you get a real rate of return on them. And then there's obviously just normal treasuries. Well, the difference in the yield between those two is called the break-even rate. And it's what inflation, if inflation comes in at that level, it didn't matter which one you're picked, you're equally as good off on a real spending basis. And so the historical average on that is usually just shy of 2.5%. And even going through the worst of our inflation times, you can see that this didn't really spike. And what that meant is that market maintained confidence in the Fed. And that is the most important thing. When people lose faith in a central bank, that's when things really spiral out of control, skyrocketing interest rates, really high inflation, things like that. There are certain countries, Argentina being a huge case of this, where they have over 100% inflation, and it doesn't matter what the central bank does because just people don't think they can tackle the problem, and so you get into this vicious cycle that just can't be broken. The Fed has always been sort of the standard bearer on their ability and willingness to control inflation and sort of do the right thing. And the market, sort of rewarded them for that. And that's actually why we've seen inflation come down less sticky than it has been in other places. I mean, the ECB has done a good job too, but really this confidence that's been maintained is a nice thing to see in the market because it keeps volatility at bay. Like we said though, I mean, rates are higher. For sure. I mean, especially compared to what we're used to. I mean, this chart goes all the way back to the 1990s. So when we look at that, that 4.49% doesn't seem particularly high. But, this is a long chart, right? So for the better part of 15 years, we really haven't seen rates anywhere near here. And then the pace of them is quite surprising too. Usually rates will slowly grind higher as the economy grows and grows, and then they fall into a recession and they start moving higher. We've had basically 0 rates to 5% rates in a very short time period. That pace of change is disruptive. I mean, people were just 2 years ago financing at very low rates that are now suddenly very high, not very high rates, but much higher rates. And that sort of inability to plan, maybe that debt load that they took on from a corporate standpoint or whatever, that's a bit disruptive. The level isn't that important, the pace of the increase is. One of the bigger things though that is still strange in the market, where yields are at, that's fine. It's like we said, within historical norms. A strange phenomenon that's occurring right now is there's this thing called the yield curve, and essentially it's what are short-term rates versus long-term rates, and there's a slope to it. And it is normal, if I'm going to lend you money for 10 years, I'm probably going to want a higher interest rate than if I lend you money for 1 year. It just makes sense because there's more uncertainty over a 10-year period than there is over a 1-year period. So it's something called the term premium. Should be positive, well-functioning markets, it's kind of normal, makes a lot of sense. Well, right now, the highest interest rate you can get is the Fed funds rate. The overnight rate is the highest rate, and the 10-year is 4.4%. That is a very unstable situation to be in. It typically is an indicator that screams recession. What it's saying is, hey, you need to lock in that 4.4% right now because there's no way you're going to get it moving forward. Short-term rates have to come down to kind of, because likely there's economic weakness or recession, right? And that's kind of what the market tends to say. The yield curve has had a decent track record. I mean, some people think it's a perfect track record, but when something's, a year early or, 6 months before, it's had a really variable effect. It does tend to precede recessions, but with a really wide time range of how well it's predicting them. So I personally find it a more questionable indicator than most. But what's unique this time is the duration of the unemployment, or the inversion. So we've been inverted really since the Fed started raising rates. And so that is, the market saying, hey, things are weird here. It's not a run for the hills scenario, but it is just an indication that there are some stresses, some uncertainty in the market, that we're kind of stuck in a prolonged, inherently unstable position. Like this just doesn't work long term. It has to fix itself one way or another. Either long-term rates have to come up or short-term rates have to go down. Right now the market is saying, and we actually think this is one of the bigger risks in the market, the market's very confident in that it's going to come from the short side of rates, and that's a really good thing for the economy. The Fed's cutting rates, we're not seeing a big spike in long-term interest rates, but I'll show you later, the level of confidence is a bit excessive in our opinion. So here is exactly what I was just talking about. If we look here, this is the probabilities of where Fed funds are going to be over the next year, through 2024. And that blue shaded area is the most likely Fed funds rate. So if you look at it right now, January of next year, they're saying the rates are going to be exactly where they are right now with 100% probability. That's pretty confident. I'm not sure there's anything that's 100% certain in this life, but market seems to think Fed funds rate at 5.25 is 100% certain. And then you actually start to see it move down. The most likely rate is they start cutting the rates until the most likely outcome at the end of 2024 is an 100 basis point, 1% cut in the Fed funds rate, which I think that's probably on the high end of what we see. I think that we will likely see cuts. There's plenty of softening in the economy. Rates are very high. There's plenty of case to cut rates. What has me a bit concerned when we look at this, and as David said, expectations move the market. You have a 0.2% chance that Fed funds rates at the end of 2024 are where they're at today. There is not a difficult scenario to paint where the Fed just kind of holds back. Inflation stays a little higher, the economy slows but doesn't crater, more or less what we've seen, and they just don't move. So that 0.2%, when I see something like that, that's what makes me most nervous. It's not that they're wrong, they're not going to cut at all, but even a slight change in those expectations, the market has to price in. So if the market suddenly moves from this incredibly confident stance to, hey, maybe things are a little more balanced than we thought, that's inherently a source of volatility, right? The curve right now, when you look at interest rates, it's pricing in a very, very low probability that rates are going to be 5% next year. So that 4.4% treasury is totally fine because if you look, by the end of the year, we're at more or less a flat yield curve. So the bigger thing though with rates, as we said, we're not overly concerned about the level of rates. We do think the pace of increases will moderate, especially with what the Fed, even if that's excessive confidence, you're likely to see some rate cuts. So we're probably nearing sort of peak rates in this cycle. The biggest thing we want to watch though, what can really cause this to create some more volatility in the interest rate markets is credit. So what we're looking at right here, this is the spread of high yield issuers. So these are below investment grade, poor credit quality companies. When they issue debt, you're obviously going to want more interest out of them than you do out of a very safe lender like the US government. So there's a spread there. Now, that's sort of the market's indication of widespread credit risk. What's the probability that you're going to be able to pay me back your debt? Because if I don't think you're going to, I'm going to charge you a much higher rate. That way, hey, even when you default at the end and I don't get my money back, at least I made some pretty good money along the way. So what you see is that rates, these spreads tend to spike in face of economic weakness because people are less and less confident they're going to get their money back. But when we look at this chart, we really see no signs of stress. And this is an important factor because as long as people are willing to roll over debt, you can kick the can down the road nearly forever. You just refinance debt, move on, refinance debt, move on. What happens, if you look at 2001, 2008, these prices, well, it's not on that chart, but those spreads went through the roof. So then when people went to refinance, no one was willing to do it. They can't pay their debt, they go into default, bankruptcy, so on and so forth. So as long as these stay in a reasonable range, it's a sign that there's ample credit available in the market, albeit at higher rates. Additionally, people look at that. The most likely time for a default is when you owe your principal back. You can make your interest payments, but then when it's time to pay back the full amount that you were loaned, that's when you're most likely to say, hey, I just don't have the money. So these spreads tend to rise ahead of those defaults. So, they're going to lead that because they're not going to wait till you didn't pay your money. Like, wow, I really should have charged you a higher rate. They're going to push those up in anticipation of that. And so even with these higher rates, these lower rated companies, they do carry a lot of debt. That's why they're poor credit quality. The market's saying, hey, you're going to roll your debt just fine. We're not worried about it right now, and that's a big thing to say that level of confidence. I'm actually surprised at how confident the market's saying. It's just surprising to me that companies so reliant on debt. The market's saying they're going to roll it no problem. Even at the higher rates, they're still going to make their payments and repay their principal in line with historical norms. What is interesting, and this is a function of a couple of different things we've already talked about, is that mortgage rates are high. They're very high right now. And typically mortgages price off the US 10-year. An average mortgage lasts about 7 years, so it's not a perfect one-to-one there because we can refi, things like that. So a 30-year mortgage, almost nobody holds a mortgage for 30 years. So with that, there's optionality in it. You can refinance your mortgage. So when there's more volatility in interest rates, there's more value in that option, right? And I think a lot of people have kind of said that. They've stretched for mortgages, they've paid more than they maybe like. It's like, in 2 or 3 years, I'll refinance anyway. This isn't a forever issue. So that optionality makes banks, they make you pay for it, right? And right now it's worth more than it normally is. So they push that spread versus the 10-year higher. The other thing is, as we talked about, the yield curve is inverted. So if I'm a bank right now, I don't think any of us are making 5.25% on our deposit accounts. So if I'm a bank and you deposit money in your deposit account, I can immediately take that and put it at the Fed, zero risk. They have a deposit account there just like we do, and they're getting 5.25%. So if you can't beat that in the loan market, why would I take the risk? So they're essentially uninverting the curve for themselves. They need some incentive to not put that money at the Fed. So they're going to say, hey, we're going to charge you 8% because otherwise I could just put this at the Fed and make 5.25%. So those two things are why this spread is actually at historic highs. It's never been this big of a spread between the two, which though is a good thing in our opinion, because as we said, the yield curve needs to figure it out right now. And I think it's going to be some combination. This is an out of consensus call. I think we're going to see kind of underwhelm the market on the pace of rate cuts. And you're going to see the back end pick up or at least stay stable at where it's at right now. But with this cushion, you actually could see mortgage rates not really move or actually fall even as broader interest rates are rising because there's more stability in the market, the yield curve flattening out gives the banks a better profitability picture, things like that. So there is, even though it's a strange phenomenon right now and there's high mortgage rates, moving forward, this cushion being so out of whack almost gives a little bit of dampening to the way we're really doing. Most people don't feel the US 10-year. We're not big treasury investors. What you feel is that everything's priced off the US 10-year. So as that moves up, things we actually do use in the credit markets, rates go up with them. This cushion just means that it may not be that sort of one-for-one we typically see. One thing that is surprising, though, is the resiliency of home prices. I mean, they are much more expensive to own with higher mortgage rates than they have been in the past. and yet we've seen almost no change in prices. This chart at the top, this is the Case-Shiller index, and it's just the median home price throughout the country. So we're at the high 310, call it, is the median home price. That certainly is not the median home price in Utah. And what we could see here is that it was going straight up post-COVID. I mean, it was a totally unsustainable pace. We had really low interest rates. Everyone could, and people were investing a lot into homes because they were stuck in their homes. And we look at that. Now we have high interest rates heading into 2023, and you barely see, the bottom chart is the year-over-year percentage change in the Case-Shiller index, and it barely dips below zero for a very short time. So housing prices have not come down to reflect higher interest rates. They've done it more or less by pausing. And that's due to a number of reasons. I think some of it is people generally just think they're going to be able to refinance their mortgages, but also there's just huge supply issues in housing. So there's just a fundamental tailwind behind housing, is that there is no affordable housing basically anywhere in this country, but especially some of the fastest growing areas like Utah. There's a massive affordability problem. So then as soon as someone can afford it, doesn't matter what mortgage rates are, as soon as I can make the monthly payments, I'm going to buy a house because I've been priced out of the market for so long, and I'm worried that I'm going to continue, it's only going to get worse, right? So that has been a big support of the housing market and probably supporting this, but at some point, the markets have to correct themselves. And as David pointed out, rents are falling. Well, if you buy a house to rent it and rent it for less than your mortgage, there's a cash element there that you're paying cash to hold that house. You need that appreciation. Otherwise, the investment doesn't really make sense. There's a parity that occurs there of like whether you should buy or rent. I mean, this is just a pure, are you better off financially owning a house or renting a house? There are only 6 cities in the country where you're better off owning right now. So across the board, and overwhelmingly in Arizona and Florida, but 6 cities in the entire country is a very low number. And this number tends not to correct itself very quickly. If you go back in the 2008 recovery, so let's say like 2010-ish, it was the total opposite. Dirt cheap to own housing, rents had responded to an improving economy, and the ratio was flipped from where it is right now. And that really persisted for three-ish years. So this isn't something that has to correct itself overnight, but it is a sign of imbalance in the market. I think because of the supply issues, I think you're more likely to see that through a continued flattening in home prices as opposed to them coming back in. But it is inherently, a disconnect in the market. Moving on from interest rates, when we look around and what's dominating the headlines right now is geopolitics. And so we obviously have the prolonged war in Ukraine, the horrific incident in Israel, and what's been a very ugly war following it. There's a lot going on in the world, not a lot of it good, and just sort of a sad time for humanity, really. When you look at geopolitics, though, they tend to not have a long-lasting effect, if any, on the market. And when we look at what's going on, the sort of new development in Israel, not a particularly large economy, the biggest in the region, but not a huge player in global trade, and also they're well protected in this war. And then the countries they're fighting and where the biggest disruption are not the largest economies. The concern in the Middle East would be should it brought into a widespread conflict. So there's sort of a united front against Israel. Things spread to different countries, Lebanon, but more importantly, you get sort of a backing of Saudi Arabia and Iran get on the same page, and there's just this consolidated push against Israel. Well, this attack was led by Hamas, which is a Iranian-backed militia. Saudi Arabia and Iran have been fighting proxy wars for the better part of a decade using these militias. Such a vicious attack is unlikely to be what triggers the kumbaya moment between the two countries to unite against Israel. The UAE, Saudi Arabia are strongly on the side of let's end this as soon as possible, peace, let this go out. So that threat of spreading, in our opinion, is relatively small from a geopolitical standpoint, just the way relations between the two countries have gone. And even if it did spread, it would show itself in volatility in oil prices. That especially if Iran were to get involved and they try to disrupt supply chains, things like that, that could show itself in higher oil prices. The thing is, though, the U.S. economy, which is kind of what drives the global economy, is far less reliant on oil than it has been in the past, far less reliant on Middle Eastern oil. The U.S. is the largest producer of oil in the entire world, more than Saudi Arabia. North America, totally energy independent from Middle Eastern oil. So the impact of this, even if it should become a widespread conflict, is not the same as it was in the past. And actually, you can even look, the response in oil prices was much less than it was even in the Gulf War. In 1993, you saw a much bigger response because we were much more reliant at that time on foreign oil. And then you go back to the 70s, the Iran embargo. There's huge impacts from a shutdown in Middle Eastern supply. That just wouldn't happen this time. So that's sort of, this is a humanitarian crisis, not an economic crisis. And that's, the humanitarian toll is very, very sad. Realistically, from a markets and investing standpoint, this is unlikely to have any prolonged effect. In fact, it's a much smaller shock than what we already saw with the Ukrainian war. That was a bit more disruptive because you immediately had Europe get cut off from natural gas from Russia, which they were very dependent on. They're a very different story than us with oil. Europe absolutely needed Russian natural gas, and overnight they didn't get any. Weathered the storm incredibly well, and a strong political front there that they took some pain and higher prices to kind of do the right thing and punish Russia. So with U.S. politics, again, similar to geopolitics, this is what gets the news headlines. It's the fun thing to talk about, argue, get people riled up, great for TV ratings. Again, doesn't really matter to the economy. Markets don't care what party's in control. They don't really care, anything. What markets like to see is stability. And so what we do see right now is actually positive news. We just recently avoided the government shutdown. That would have been disruptive because we are seeing consumption roll over. A lot of people work for the US government, and if they're suddenly furloughed, heading into a very important seasonal spending time, Christmas budgets are going to go down if you're furloughed. Even if you say, hey, they'll figure it out sometime, we've been through this before, you're still naturally not going to spend as much time into a very important cycle for retailers. So the fact that was avoided, that, in our opinion, was the only real issue that was on the table that would say, okay, that's a political issue that could cause some problems in the economy, especially as we're seeing consumption start to roll over, especially at lower income levels. We're starting to see debt levels rise, things like that. We are in a political election year, obviously, and so we'll see, tons of ads and headlines and, heated debate on TV. But really what it means on these years, and it doesn't really matter because we have a divided government anyway, is that people tend to dig their heels in, want to rally behind their team, and you don't see major legislation. Markets like that. Bad policy is better than uncertain policy for business. It's like you could say, hey, this is a dumb rule, but at least I know the rule, right? If you don't know the rules, it's very hard to plan moving forward. So regardless of what they think of the regulatory landscape right now, there's reasonable confidence that it's not going to change dramatically because of the impasse there. An election year further puts us into that unlikelihood of major legislation getting passed, making businesses say, hey, the rules aren't changing anytime soon. With that, we're overwhelmingly likely to see a rematch of Biden and Trump, so kind of more of the same in the election there. We're just going to do the 2020 election over. And then within Congress, and this is where you would start to see, should you get one party in control of the executive branch and Congress, that's when you're going to see major legislation, right? It's very hard to get anything meaningful done unless you control both chambers of Congress and the executive branch. We are also unlikely to see that. In fact, it's just a weird thing that the most likely outcome is that the Senate will flip, very, very likely now with Manchin retiring. So the Senate's likely to flip and become a Republican Senate. However, the House is likely to flip the other way and be a Democratic House. At that point, who cares who the president is because there's just no major legislation getting through from a business standpoint. So we're likely to see this sort of divided government moving forward. Markets do tend to cheer that. So not a bad outcome for markets. When we look at this, as we said, it's overwhelmingly likely to see an election. This early in a primary season, Trump has 58% of the Republican vote right now. without even participating in the debate. I mean, this is the largest runaway primary we've seen. You know, you pool everything together, it doesn't even come close. You know, and then especially too, if you had the more moderate vote, you know, you would say even you add up Nikki Haley or other moderates in the race, it still becomes, there is no legitimate other choice than Trump as far as the polling is concerned. So he's heading into an election versus a very unpopular president. And these, you know, approval ratings aren't the best indicator of whether they're going to win an election or not. Obama's approval ratings were quite low heading into, you know, his matchup with Mitt Romney, which he won, you know, in a landslide. But you'd obviously want to have a higher approval rating than a lower approval rating. There's a lot of weakness in swing states right now for Biden. So it's going to be a very close race that right now is slightly favoring Trump. But again, we want to reinforce, you know, it's what people are going to talk about, doesn't tend to matter, you know, especially if you end up with a divided government. So in summary, for the economy, we think that growth is likely to continue. We're not on the recession bandwagon. We haven't been for some time, and that we kind of were proven right on that one. You know, any recession, should we see it, would be very, very mild in our opinion. And right now we're just, because we just don't see, especially that credit market that we talked about, credit is what gets you deep recessions. Even overvalued stocks, if you go back to 2000s, you saw crazy valuations of the stock market that cratered. I mean, people lost a lot of money because anything with .com at the end of it was suddenly worth $1 billion. And then the market kind of came to its senses, you had a big correction there. The loss of wealth in that big correction, the stock market driven recession, you know, it absolutely led to a recession. Very, very mild one and a very short one. Whereas you go to 2008, that's a debt-driven recession, much more painful, and it lasts a whole lot longer. You know, even though you could say the recession, I think they said it ended somewhere mid-2009, 2010, is when the recession officially ended. In a lot of ways, that recession really, you're still feeling the pain from it well into 2013 or so. That's the difference between a debt recession and a stock market-led recession. And right now, until there's problems in the debt market, we just don't see the recipe for a deep debt-led recession. If there was something, it probably comes from just a little bit of, you know, concerns over the Fed. If it's a Fed-driven recession, they can step in very quickly and kind of slow the problem down, unless those rates bleed into credit. So that's sort of the big risk out there, or that stocks get ahead of themselves. We have seen quite good rallies. You know, maybe valuations get excessive, we get a severe pullback in the market, and then, you know, you get a mild recession out of that. With that, markets certainly aren't saying that. David alluded to this quite a bit. We're up about 17.7% year to date, so a very, very strong year in the S&P 500. And so that's the market saying, hey, you know, you're not going to do that if there's a recession next year, if there's going to be this crash. When we look at other things, most importantly, when you see a rally like that, we want to say, okay, are we getting back to that .com bubble? You know, we've seen a huge rally in the face of, you know, it's a decent economic picture, but this isn't like, you know, an amazing economic picture to support a 17% rally. We, you know, reasonably valuations, we would question valuations at this point. What we're looking at right now is with interest rates, there's something called the earnings yield. So if I take the price of a stock, take the earnings of stock and divide it by the price of that stock, you can almost think of it as a bond at that point. It's for what I'm paying for the stock, what earnings yield am I getting? So when we look at that versus the higher interest rates, because that's really what's changed a lot, is that, hey, relative to bonds, which I can actually make money in bonds now for the first time in a long time, has that gotten out of whack? Are stocks not earning enough to keep pace with higher interest rates? And so this chart here is that earnings yield. And what we see is actually it's been getting a little bit better. It's been getting worse, but it's still within historical norms. And that to have it absorb such a jump in interest rates, you know, is you know, pretty impressive. So when we look at this, we're not seeing huge issues of overvaluation in the market, despite, you know, the strong rally we've seen. One thing we will continue to look at, though, is this as we talked, the inverted yield curve. This is kind of a weird situation that's going to keep people, you know, a little hesitant to continue to pour into stocks, because we're just looking, we see, hey, there's some instability in the market right now. Whether you're saying that's a recession, whether that means that there has to be higher rates, regardless of what it is, there will be volatility around the correction of this inverted yield curve. One of the other things that's very unique in this market right now is that stocks and bonds are moving together. Normally, if I want to, I'm nervous about stocks, I sell my stocks and I want to buy US Treasuries. So the price of Treasuries goes up, the price of stocks goes down. So it's just a class that they call a risk-off trade. Right now, that's not what's happening because everybody's focused on interest rates. So interest rates go up, bond prices go down, stock prices go down as well. That creates a situation where there's nowhere to hide. So that inherently makes people nervous. If there's no way that I can pull risk off the table in a meaningful way, I'm less prone to take risk. Additionally, when you get into financing, people, levered investors, which hedge funds, things like that, large investors that depend on leverage, they're going to have very strict risk controls around what they're going to do. Even banks and what they're willing to do in credit, things like that, they have these models that tell them how much risk they're taking and how much risk is acceptable. There's a risk officer that says, hey, we're willing to take this level of losses, but you can't go beyond that. Well, when this relationship is messed up like it is right now, the risk models kind of don't work. They kind of are saying like, hey, this is how the world's supposed to work. It's not working that way. So what people do is just say, hey, we're just going to put a wider cushion into this because we can't really quantify risk the way we usually can. And even if we could, we can't pull risk off the table in any meaningful way because there's nowhere to put it. So this shows the correlation, that's the measure of how much they're moving together between stocks and bonds. And as you can see, red is below zero, and the normal resting pulse of this is that they move in that opposite direction. That's the stable state of the economy. We have to get back to that at some point, but we're not there and really won't be there until the focal point turns away from the Fed and away from interest rates. But that is inherently just sort of something to keep money on the sidelines because people just are like, hey, this market's a bit out of whack, and this has persisted. Just like the inversion of the curve, this has persisted for an unusually long time. The other sort of concern that we see in the market right now is about 8 stocks have led that 17% rally. So if we take the S&P 500, which is that blue line there, we just said we're seeing a 17% gain year to date. This goes back a bit farther. The orange line there is the equal weighted index of S&P 500. The way S&P 500 is a market cap weighted index. The bigger companies are a larger portion of the S&P 500. So when they ate these, they're calling them the Magnificent Eight. And Microsoft, Apple, Nvidia, these huge companies that have had phenomenal years. Well, they're the biggest holdings in the S&P 500, so they can really drive the returns there. But if we said, hey, let's not market cap it. There's 500 stocks. Let's just invest equally across them. Now we have an equal weighted index. When we go to that equal weighted index, we're actually negative on the year. That says is there's not a lot of breadth to this market. There's 8 companies that are doing really, really well, and everybody else is kind of flatlining. That can cut both ways. One is say, hey, don't stare at that S&P 500 and say, wow, look at this, everything's great, because as soon as you open up the hood, it's like, well, not everything's great, and that can be a bit concerning. But if you want to do the glass half full approach, it's saying like, wow, 17%. How can we possibly continue this? It's like, well, there's 492 stocks that haven't seen this. So we could see we could see a reversal and have them sort of pick up the slack because they haven't moved up. Valuations are actually quite good there because they flatlined while the economy has improved. So that is both a risk. I'm going to lean on it more as on the risk side of things, but I always want to keep the window or the door open for a glass half full approach. So that's all we had prepared, but we do want to take questions. So if anyone has anything, fire away.